was put in place in the year 2016 and it was reviewed in the year 2021. You are all also aware that this is a monumental change in the monetary policy history of our country. And so I thought it fit that I reflect on the experience of the flexible inflation targeting framework. Well, I believe that it has served the Indian economy very well over these years, including the very challenging period since the pandemic. The average inflation has been lower post the introduction of this framework. Moreover, CPI has mostly stayed aligned with the target given under this framework, barring a few occasions of breaching the upper tolerance band since its inception. We in the Reserve Bank and the Monetary Policy Committee will continue to improve the macroeconomic outcomes in the best interest of the economy, using the flexibility which is embedded in the framework, while responding to the evolving growth inflation dynamics. Moreover, we will strive to further refine the building blocks of this framework by making advances in the use of new data, improving nowcasting and forecasting of key macroeconomic variables. We forecast, you are aware, growth, inflation, etc., because this is actually a forward-looking policy. And so we'll continue to do that and develop more robust models. On the regulatory front, I would like to mention, and especially there has been a lot of media attention with regard to some of the proposed regulatory changes pertaining to liquidity coverage ratio, expected credit loss framework for provisioning by banks, the prudential norms governing projects under implementation. We will continue to strengthen, rationalize, and refine the prudential and conduct related framework. I think this is very important in the overall interest of our economy. The interest of the economy demands financial stability and consumer protection. Our mandate in the RBI is to enhance both of them. At the same time, I would like to emphasize that the economic interest also warrants increasing efficiency in the economy, and this too is our duty. We recognize that just like there are no free lunches, regulation to enhance stability and consumer protection too is not devoid of costs. There are trade-offs between stability and efficiency. We will keep this trade-off in mind while formulating each and every regulation. It will be our attempt to strike the right balance, keeping in view the benefits and costs of regulation. I also want to reassure all stakeholders that we will continue with the consultative process which the RBI has been doing over the years in this regulation making process. The suggestions of the stakeholders are very valuable, and we will continue to give serious consideration to them before taking any major decision. We will also ensure that the implementation of such regulations is smooth. We will give sufficient time for transition, and where regulations have major implications, the implementation will be done in a phased manner. Coming to the global economy, the global economic backdrop remains challenging. The global economy is growing below the historical average, even though high-frequency indicators suggest resilience, along with continued expansion in trade. Progress on global disinflation is stalling, hindered by services price inflation. With receding expectations on the size and pace of rate cuts in the US dollar has strengthened, bond yields have hardened, emerging market economies have witnessed large capital outflows, leading to sharp depreciation of their currencies and tightening of financial conditions, divergent trajectories of monetary policy across advanced economies, lingering geopolitical tensions, and elevated trade and policy uncertainties have exacerbated financial market volatility. Such an uncertain global environment has posed difficult policy trade-offs for emerging market economies. The Indian economy, though continuing to remain strong and resilient, also did not remain immune to these global headwinds, with the Indian rupee at our disposal to face the multi-pronged challenges. With this backdrop, let me now come to the Monetary Policy Committee resolution. As I mentioned, we met these last 3 days, concluding today. And after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook, as I mentioned, we are forward-looking, the MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. I repeat, the MPC unanimously decided to reduce the policy rate by 25 basis points from 6.5% to 6.25%. Consequently, the standing deposit facility, SDF, the SDF rate shall be at 6.0%, and the marginal standing facility rate, also called the MCF rate, and the bank rate shall be 6.5%. The MPC also decided unanimously again to continue with the neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. I shall now state the rationale for the decision in brief. The MPC noted that inflation has declined, supported by favorable outlook on food and continuing transmission of past monetary policy action. It is expected to further moderate in 2025-26, gradually aligning with the target. The MPC also noted that though growth is expected to recover from the low of Q2 of 2024-25 this year, it is much below that of last year. Last year, you are all aware, it was 8.2%. This growth inflation dynamics opens up policy space for the MPC to support growth while remaining focused on aligning inflation with the target. And accordingly, the MPC decided to reduce the policy rate, by 25 basis points to 6.25%. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. With this now, I come to the assessment of growth and inflation. First of all, growth. As per the first advanced estimates, real GDP growth for the current year is estimated at 6.4%. The numbers were released by MOSPI recently. This is a softer expansion after a robust 8.2% growth last year. Going forward, economic activity is expected to improve in the coming year. Agricultural activity remains upbeat on the back of healthy reservoir levels and bright Rabi prospects. Manufacturing activity is expected to recover gradually in the second half of this year and beyond. Early corporate results for Q3, and we have more than 50% of the results now as we speak. It indicates a mild recovery in the manufacturing sector. Mining and electricity are rebounding from monsoon-related disruptions in Q2. Business expectations remain upbeat, as evident from the PMI Manufacturing Future Output Index. Services sector activity continues to be resilient. PMI services, however, declined from its recent peak. On the demand side, rural demand continues to be on an uptrend, while urban consumption remains subdued, with high-frequency indicators providing mixed signals. And we are aware, we got the Nielsen survey report also just yesterday. Going forward, improving employment conditions, tax relief in the union budget, moderating inflation, together with healthy agricultural activity, bode well for household consumption. Government consumption expenditure is expected to remain modest. Higher capacity utilization levels, robust business expectations, and government policy support augur well for growth in fixed investment. Continued buoyancy in services export will support growth. Global headwinds, however, continue to impact uncertainty to the outlook and pose downward risks. Taking all these factors into consideration, the RBI has estimated that real GDP growth for the next year to be at about 6.7%, with Q1 at 6.7%, Q2 at 7%, Q3 at 6.5%, and Q4 too at 6.5%. The risks are evenly balanced. Coming now to inflation, headline inflation, after moving above the upper tolerance band in October, has since registered a sequential moderation in November and December, standing at 5.2% now. Going ahead, food inflation pressures, absent any supply side shocks, should see a significant softening due to good Kharif production, winter easing as we witness every year in the vegetable prices, and a favorable Rabi crop prospect. Core inflation is expected to rise but remain moderate. Rising uncertainty in global financial markets, coupled with continuing volatility in energy prices and adverse weather events, presents upside risks to the inflation trajectory. Taking all these factors into consideration, CPI inflation for the current financial year is projected at 4.8%, with Q4, the current quarter, at 4.4%. Assuming a normal monsoon, CPI inflation for the financial year 2025-26 next year is projected at 4.2%, with Q1 at 4.5%, Q2 at 4%, Q3 at 3.8%, and Q4 at 4.2%. The risks are evenly balanced. I will now come to the external sector. India's current account deficit moderated from 1.3% of GDP in Q2 of last year to 1.2% in Q2 of this year, 24-25. According to the World Bank, India, with an estimated inflow of $129.1 billion US, continues to remain the largest recipient of remittances globally last calendar year 2024. The current account deficit for this year is expected to remain well within the sustainable level. As on 31st January this year, I may inform you, India's foreign exchange reserves stood at 630 plus billion US dollars. This provides us an import cover of more than 10 months. Overall, India's external sector remains resilient as key indicators stay robust. I would like to mention over here, and especially because there has been commentary in the media about the Reserve Bank's exchange policy. Well, the Reserve Bank's exchange rate policy over the years has remained very, very consistent. Our stated objective is to maintain orderliness and stability without compromising market efficiency. The Reserve Bank believes in the market efficiency of the markets that we have in India for Forex. Accordingly, our interventions in the Forex market focus on smoothing excessive and disruptive volatility. It does not target any specific exchange rate level or band. The exchange rate of the Indian rupee is determined by market forces, and we will continue with this policy. Coming now to liquidity and financial market conditions, I may state that after remaining in surplus from July to November 2024, system liquidity as measured by the average net position under the liquidity adjustment facility did turn into a deficit during December 2024 and January 2025. This drainage of liquidity is mainly attributed to advanced tax payments in December 2024. You are aware there are quarterly advanced tax payments to be made, December being that particular month. For the advanced tax payments for Q3, that did have an impact. Capital outflows, again, one has witnessed some capital outflows because of various reasons. Forex operations, and a significant pickup in currency in circulation as we witness every year in January. It has been, however, I would like to mention over here that we have observed that some banks are reluctant to on-lend in the uncollateralized call money market. They are passively parking funds with the Reserve Bank. I take this opportunity to all the banks to urge them to actively trade amongst themselves in this uncollateralized call money market, so as to make it deeper and vibrant for better signal extraction from the weighted average call money rate. The Reserve Bank is committed. I want to assure everyone that the Reserve Bank is committed to provide sufficient system liquidity. We have taken a number of steps in this regard, and we will continue to monitor the evolving liquidity and financial market conditions and proactively take appropriate measures. I repeat, proactively take appropriate measures to ensure orderly liquidity conditions as may be required for the system. And when I say liquidity, it means not only transit overnight liquidity, but also durable liquidity to meet the requirements of the system.
Governor Sanjay Malhotra there giving the outcome of his first monetary policy committee meet. And yeah, the big news coming in is that, as expected, the repo rate has been cut by 25 basis points. The central bank's lending rate to other financial institutions has been cut from 6.5% earlier to 6.25% now. But that's not all. The RBI governor has also given some projections on the growth rate of India's GDP for FY26 and also inflation targeting both for this quarter of the present financial year as well as the overall and quarterly split for the next financial year. So growth is expected to come in at about 6.7% for FY26. That is what the RBI governor has just mentioned a few minutes back. We are looking at revised growth estimates for next year at about 6.7%. Remember, this would be about 3 points higher or 0.3% higher than the growth estimate for this financial year, which has been revised by the Ministry of Statistics to about 6.4%. The next financial year, we are expected to grow faster at about 6.7%. On inflation targeting as well, the RBI governor has mentioned that the quarter 4 inflation print, the headline inflation for this current quarter of January, February and March will come in at about 4.8%. Lower than the 4.9% for the previous quarter, and going forward the inflation targeting for FY26 has been made at about 4.2%. So these are the updates of the Monetary Policy Committee meet. The RBI governor has also said that the RBI is committed to walk the tightrope between inflation management as well as the economic growth of the country, and that seems to be the underlying message of the decision of the central bank at the MPC. In addition to that, the RBI Governor, Mr. Sanjay Malhotra, has also gone on to say that the RBI will work to ensure there is enough liquidity in the system. He's mentioned that India's forex operations are also going to be market determined. The price of the rupee, which has seen record lows in the last few days, is going to be determined by market forces. And the RBI, despite the open market operations, still has enough and more forex to cover India's needs for more than 12 months. India's forex reserves stand at about $630 billion. Joining me to make sense of the RBI governor's latest decisions is economist Mithali Nikore. Mithali, good morning. Thank you for joining us. As expected, there's been a 25 basis points cut in interest rate. What does this mean for the consumer who's grappling with high inflation? Inflation hasn't come down to the 4% target that RBI has maintained for the last many years. And even Shaktikanta Das, the previous RBI governor, kept hammering the inflation down by hike after hike until 2 years back. But inflation still above 4%, RBI decides to cut interest rates.
Absolutely. First of all, good morning. And I think thanks a lot for having me on the show. And I think, this is something we have been expecting since December. Since the previous RBI MPC meeting, we were actually expecting the rates to be cut in the previous meeting itself, but they were held constant at that time. And, now with the new RBI governor coming in, it was widely expected that, we would be seeing this rate cut, and this rate cut has come through. Now, what does this really mean for the liquidity of the consumer? I think one message is very clear from the government as well as from the RBI, that the focus is on empowering the Indian consumer. Whether it's the tax cut that has been passed on to the middle class, or the cut in the interest rate that is again going to benefit the middle class, both the measures together are really empowering the Indian consumer to go ahead and restart their spending. The spending cycle has to be restarted, and that's something that's very clear from this rate cut. The second thing is around investment. I mean, the rate cuts also have a positive impact on private sector and domestic sector investment. So I really think that, with this rate cut, we might start seeing some amount of softening in the investment cycles, and, domestic private sector investment also getting reignited with this rate cut. So both these are, coming together, the tax cut and the rate cut, and this is very good news.
Right. So, Mithali, help us understand. One part of the RBI rate cut is tackling inflation management, and the other side is propelling growth, and the cost of capital comes down. What happens to now, let's say, people who want to go ahead and take home loans or car loans and really kickstart that consumption cycle that in urban areas has been weak? And parallelly, what happens to the investments that they have made in, let's say, instruments like bank deposits?
So I think, again, these have two different impacts. If you want to go ahead and take a home loan or a car loan today, that's definitely going to be cheaper because the rate has been cut, the interest rate, repo rate has been cut, and this is generally passed on by private banks to their consumers, especially to, middle class consumers. This is likely to be passed on for, restarting the investment and consumption cycle. So definitely home loans, car loans, and your EMIs as well, even on your existing loans, likely to get cheaper. So again, more money in the pocket of the consumer. But on the other hand, for those who are saving and who have saving instruments, sometimes these are also passed on in, fixed deposit interest rates are also reduced, and the payouts on your saving instruments might be reduced. But sometimes banks may say, okay, we will not pass on that rate cut in, for example, the returns that you're getting on long-term saving instruments. So they might pass on the rate cut only in the short-term saving instruments. So if you have saved for 5 years or 7 years, maybe you will see your return lower. But if you have saved for a good 20-year instrument, then you might not see any decrease in your returns because that might not be passed on by the private banks.
Mithali, how long before banks actually pass on the RBI's rate cut decision to consumers, both on the end of home loans and car loans that people want to go ahead and take, and also on the fixed deposit? So if I remember right, and correct me if I'm wrong, it's usually the interest rate on fixed deposit that gets slashed immediately, but the home loans actually take much longer for banks to pass on to consumers.
Absolutely, Karthik. We would want it to be the reverse, isn't it? We would want that the FD rates should be held for some time and then the loan rates should be cut immediately. But of course, banks have their own systems, and I do expect that within this week we'll start seeing some changes in the home loan rates and car loan rates, as well as a lot of fintech platforms now coming in. See, as we have more and more competition in the market, as we have more and more lenders available in the market, the speed at which the rate cuts are passed on to consumers will become faster. And I think at this point in time, the Indian financial markets have evolved to a great extent. We have a whole lot of financial tech, fintech lenders, who are now starting to operate out of centers like Gift City and other fintech hubs in the country, especially Mumbai as well. And I do expect that these will be first, these will be the first lenders to start to pass on this cut entirely to the consumers, and then the bigger banks will follow through the week. And definitely the FD rates, I expect that by tomorrow morning, we will all have emails sitting in our inboxes saying your FD rates returns will now be revised in line with the RBI announcements. And I generally find that to be the very next day that we start to see that in our inboxes.
Right. Now, help me just understand one more thing, Mithali, since you're here with us on this very important day. What happens to the INR? How is the rupee going to get impacted with this rate cut? Because to my understanding, now the differential between, let's say, the interest rate that US offers and India offers narrows with this rate cut. So does this mean more flight of capital, more flight away from India's bond market, and will that come into India's equity market, or is that going to leave India altogether, and hence what happens to the rupee against the dollar?
So, see, what happens in this case is a little bit complicated because there are two effects again at play. The first effect that's at play is that now it's today cheaper to invest. If you're getting a loan from the market, from any of the bond markets, if you're getting a loan from even the debt market, that is actually cheaper to now invest in Indian equities. Indian equities suddenly become a bit, more accessible. So there is also an inflow of, foreign capital, which is looking for, say, longer term investments and can come in and borrow on the Indian debt market and then invest in the Indian equity market. So I think, there's one effect which actually is a positive. And the negative effect is actually for the foreign institutional investors, the short-term investors who are looking for, the differential return to make on that differential return. So of course, as the differential narrows, they will be the ones exiting. And we have seen in the last 6 months, in any case, the FII activity has been, of the nature that they are exiting the Indian equity markets simply because of the developments in the US markets overall, with President Trump also coming in. So I think what is happening in the FII markets is a little bit outside of the domestic control. It's outside of RBI's control, but surely this will help to attract some more FDI by making it cheaper to borrow in India and then invest in India, which is a route that some of the FDIs are starting to take. I mean, it's not a very popular route, but it's starting.
All right. And I think the RBI governor also more than once, Mithali, mentioned the fact that geopolitical tensions, geo-economic concerns, as well as climate, weather-related patterns are going to impact inflation. What are some of these? See, whether we understand, of course, we can't really control what is the rainfall in the country or outside going to be, but what are the other geo-economic factors right now that may have a bearing on inflation? And the fact that the RBI governor has kept the RBI stance at neutral, which means the interest rates could move either way depending on what happens in the world. So explain to us what this stance really means, and what are the macroeconomic factors, international and domestic, that can move inflation targeting either way.
So I think first of all, Karthik, we should realize that with this rate cut, there will be a upward impact on inflation. If everything else is held equal, ceteris paribus, as we say in economics, definitely inflation would increase because we are seeing consumption activity increase, investment activity increase means inflation will go upwards. However, in order to manage that, what the RBI is sort of saying is that we are investing in improving supply chains, because the three major reasons why inflation goes up is: one is fuel prices, the second is food inflation, and the third is general consumer inflation. So by improving supply chains, we can at least manage food and general consumer inflation. However, having said that, we've been covering inflation and we've been covering these climate related constraints for the last 5 years and 6 years that I've been working with you. And I honestly feel that more could be done on this area. We should have seen more fiscal investment. We should see more public sector investments to strengthening and making our climate resilient supply chains real. We can't just say, oh, the weather is beyond anyone's control. We now have, technology to predict, even complex weather patterns. We now have technology that we can leverage to measure, when is at least a 3-day or 4-day advance notice on what kind of rain is, for example, going to come in. And we have technology for improving storage, like, for example, silo bags, which is a very, like a very flexible technology to store grains. That's just one example. I mean, there are so many other examples of technology out there. So I do feel that we need to invest better in making our agricultural supply chains far more climate resilient. We need to invest in better seed technology. And I don't think that on this we can give the government any, rope or leeway to not perform anymore. I mean, on this front, I really feel that more needs to be done.
Quickly listen in again to what RBI Governor Sanjay Malhotra said just a few minutes back on his rate decision. Mithali, stay with us. We will come back to you.
MPC also decided unanimously again to continue with the neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. I shall now state the rationale for the decision in brief. The MPC noted that inflation has declined, supported by favorable outlook on food and continuing transmission of past monetary policy action. It is expected to further moderate in 2025-26, gradually aligning with the target. The MPC also noted that though growth is expected to recover from the low of Q2 of 2024-25 this year, it is much below that of last year. Last year, you are all aware, it was 8.2%. This growth inflation dynamics opens up policy space for the MPC to support growth while remaining focused on aligning inflation with the target. And accordingly, the MPC decided to reduce the policy rate, by 25 basis points to 6.25%. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. With this, now I come to the assessment of growth and inflation. First of all, growth.
Okay, so growth and inflation targeting has also been done by the central bank, and inflation targeting at 4.8% for this quarter and 4.2% going forward. And on the growth front, the RBI is saying that Indian economy is expected to grow at 6.7% for the next financial year, FY26. Mithali continues to be with us. Mithali, 6.7% on real terms. Add a 4.2%, 4.8%, I think for next year, the inflation targeting 4.2%. So 6.7% plus 4.2%. Are we looking at the kind of, nominal growth rate that we want for the Viksit Bharat and 5 trillion economy to come true?
So I think, Karthik, we've been discussing this since the day the budget came out, right? I mean, how do we meet this 8% real GDP growth target? And, at the end of the day, I definitely feel we have to understand we are still the fastest growing emerging economy in the world, and even if we weren't the fastest, I mean, though we could be the second or the third, and we could still be, on a higher base effect doing very well. So there have been a huge amount of number of people who've been lifted out of extreme poverty. We've been seeing our, urban infrastructure improving. We've been seeing our logistics infrastructure improving. We've been seeing our agricultural productivity improving. So there is no doubt that, in the last 10 years or 15 years, we have done extremely well as an economy. However, like you said, to go forward, it is now extremely essential to kickstart not only the standard engines of the economy, which is consumption, as has been done with the combination of the tax rate and this rate cut that has been announced today, but also to make our economy more innovative and climate resilient. If we don't work on those two areas, then it will be very difficult for us to achieve the targets of a Viksit Bharat. Today we have to compete with global giants when it comes to artificial intelligence. We have to compete with global giants when it comes to even making their supply chains more climate resilient. I mean, even countries like the US are talking about investing in places like Greenland only because of the kind of minerals and metals that are available in Greenland. So I think we really have to start becoming more forward looking and innovative in some of the growth trajectories and the schemes that are being introduced. We have to think about how can we bring in more private investment into high tech areas.
Right, Mithali Nikore, thank you so much for taking out time and joining us on this very important day. Remember, the RBI has decided to cut repo rate by 25 basis points, but markets are not reacting quite positively to this news. In fact, markets had already priced in a 25%, a 0.25% or a 25 basis point cut in interest rate. Markets opened about 0.1% down, but Nifty 50 on your screen right now down about 0.3%. Just about managing to hold levels at about 23,500 levels or so. Volatility has gone down to under 14, now at about 13.95%. The small cap index is the worst hit this morning, down about a percentage point or so. Let's look at the Nifty 50 heat map, and the interest sensitive sector, the BFSI sector, has a mixed bag. In fact, it's just HDFC Bank and Bajaj Finance that are in the green this morning. ICICI Bank down almost a percentage point, SBI down about 1.4% or so. So this is the market update after the announcement of the RBI's decision to cut rates. But before we head into a break, let's quickly look at all the other headlines making news this moment. Repo rate by 25 basis points. The revised rate now stands at 6.25%, down 25 basis points from the earlier 6.5%. And even as RBI cuts interest rates, inflation bites into homemade veg and non-veg thali prices. Veg thali costs 70 paisa more than last year, while high chicken prices up almost 50% take non-veg thali from 52 rupees to 60 rupees as per a CRISIL report. Ahead of the RBI's decision to cut interest rate by 25 basis points, rupee recovered slightly, up 16 paise in early trade to 87 rupees 43 paise against the US dollar. Remember, RBI Governor Sanjay Malhotra said that the rupee rate will be determined by market forces, and there's enough forex available with the Reserve Bank, upwards of $630 billion. Moving on from the RBI, with the week after Budget 2025 drawing to a close, will Finance Minister Nirmala Sitharaman get the cabinet nod for the new income tax bill and present it in Parliament today? In corporate news, a controversy has erupted over Ratan Tata's will. A former Tata Group employee, Mohini Mohan Datta, indicates he expects a third of the late industrialist residual estate. A Times of India report estimates the value of his share to be about 650 crore rupees. Dipinder Goyal led Zomato to rebrand the parent group to Eternal, comprising food delivery app Zomato, quick commerce app Blinkit, live events business District and kitchen supplies unit Hyperpure. Goyal says the ticker name to also change from Zomato to Eternal. Indian benchmark indices open on a flat note, in fact a gap down opening with a negative bias. Nifty 50 starts 0.1% down in early trade, slips to 0.3% during the MPC announcement. And now there's no sign-up required to use ChatGPT. OpenAI makers announced that users no longer need to create an account to use ChatGPT search engine, making it more accessible in the wake of DeepSeek's penetration. And reports indicate Apple could launch the new iPhone SE, the small form factor, as early as next week. The iPhone maker could unveil long-anticipated overhaul of the small-sized iPhone SE in coming days to spur growth and entice consumers to its low-cost iPhone.
And I'm falling for you like crazy. Ah, boom, boom. Every heartbeat is only for you. Every breath, every moment with you.
Shall we do it again?
My heart goes boom.
Unlimited Love. Bookings open on 14th February.
खेला होगा हर नहले पे बहला होगा दिल बड़ा है स्टेज बड़ा है पूरा भारत साथ खड़ा है we are the tigers साथ खड़ा है we are the tigers गेम बड़ा है dribble like a rap pass setting up the trap kick it hard in the boot chuck there for the ball we are the tigers chuck there for the ball
Mama must be missing us, na?
Let's take it one bit, give me one day. Feel the itch under my skin, it's a one day. You believe it when you see we end up, hey. It doesn't matter, just gotta get going.
New GT line, Tygoon and Virtus. Volkswagen.
Welcome back. You're watching News 9. Let's now look at the global headlines in news this morning. China files World Trade Organization complaint against US President Donald Trump's new tariffs, calls them protectionist and rule-breaking. Israeli Prime Minister Benjamin Netanyahu rejects US troop involvement in Gaza, defends Trump's controversial displacement remarks. Meanwhile, Trump reimposes sanctions on International Criminal Court officials amid Netanyahu's Washington visit and Gaza war probe. Benjamin Netanyahu gifts Trump a golden pager, referencing Israel's Hezbollah strike. Meanwhile, Trump calls him a great leader. Wall Street ends mixed as investors assess earnings. Pinterest soars on AI ads. Amazon cloud revenue disappoints. Bitcoin tumbles as trade war fears rattle markets, while European Central Bank pushes for digital euro amid regulatory uncertainty. Bank of England cuts interest rate to 4.5% from 4.75%, the lowest for more than 18 months. Nissan rejects Honda's subsidiary plan, calls off merger talks amid growing differences between the two auto majors. Vaccine maker AstraZeneca's shares jump 5% as drug maker downplays impact of a $4.5 million China tax probe.
Look, and I'm falling for you like crazy. Ah, boom, boom. Every heartbeat is only for you. Every breath, every moment with you.
Shall we do it again?
My heart goes boom.
Unlimited Love. Bookings open on 14th February.
Has AAP got so tarnished that it can't gain a fourth term? Will Delhi voters give BJP a chance after 26 years?
Which way did the poor and the middle class vote?
Can Congress reverse its fortunes in the capital?
What issues is Delhi voting for in this election?
What does the Delhi verdict mean for the nation? Our team here breaks it down for you like no one else.
Stay with News9. Stay with News9
Stay ahead with News9
for the most informed debates,
unmissable updates.
for the most accurate coverage.
Welcome back. Let's look at some of the global stories in news this morning. Trade war tensions escalate as China has hit back at the United States by filing a complaint with the World Trade Organization over US President Donald Trump's latest round of tariffs. Beijing argued that the new 10% levy on Chinese imports, along with the scrapping of duty-free exemptions for low-value packages, violates WTO rules and amounts to what it calls protectionist trade policies. Take a look.
China filed a World Trade Organization complaint against U.S. President Donald Trump's new 10% tariff on Chinese imports. In the Wednesday filing, China argues that the tariff, as well as Trump's cancellation of a duty-free exemption for low-value packages, are protectionist and break WTO rules. It says the duties are discriminatory and, quote, are imposed on the basis of unfounded and false allegations concerning China. Beijing's complaint also comes after Trump's move to shut a trade loophole that allowed small-value packages to be shipped duty-free. The so-called de minimis provision, used widely by e-commerce giants like Shein and Temu, exempted packages with goods worth less than $800 from duties. Around 1.36 billion shipments entered the United States using the de minimis provision in 2024. The Trump administration has blamed the de minimis exemption for allowing fentanyl and its precursor chemicals to enter the U.S. unscreened. Recent Reuters reporting has also found that drug traffickers are exploiting the exemption. Beijing's Wednesday WTO filing could lead to a ruling that Trump's duties violated trade rules, in the same manner that a 2020 ruling found that his first-term China tariffs broke trade regulations. However, such a victory would be unlikely to satisfy Beijing because the WTO's appeals body has been largely inoperable for years. That's because of Washington's blocking of appointments of appellate judges over what it views as judicial overreach by the body, which has prohibited a final decision in the 2020 case.
US President Donald Trump is once again taking aim at the International Criminal Court, authorizing fresh sanctions against those involved in investigating US citizens or allies like Israel. The move comes as Israeli Prime Minister Benjamin Netanyahu visits Washington just days after the ICC issued warrants for him, his former defense minister and a Hamas leader over the Gaza war. It's still unclear how soon the US will name those sanctions, but the measures could freeze assets and bar entry into the US, a repeat of Trump's first-term actions against the court. The ICC has yet to respond. Meanwhile, Israeli Prime Minister Benjamin Netanyahu hit back at the ICC, calling the arrest warrant against him and his former defense minister a political move. Listen in.
A decision to issue an arrest warrant against me, the democratically elected Prime Minister of the State of Israel, and our former defense minister, was made by a rogue prosecutor who's trying to extricate himself from sexual harassment charges, and by biased judges who are motivated by anti-Semitic sentiments.
Meanwhile, Israeli Prime Minister Benjamin Netanyahu presented US President Donald Trump with a golden pager and a regular pager during their meeting at the White House. The gift, including the ordinary pager, was a reference to Israel's deadly attack on Iran-backed Hezbollah militant group using pagers that exploded in September 2024. Impressed by the gesture, Trump said that was a great operation. In return, he presented Netanyahu with a framed photo from their visit inscribed with a personal message to Bibi, a great leader. Meanwhile, the Bank of England has also cut interest rates by 25 basis points to 4.5% from 4.75% yesterday, slashing its growth outlook for the year by half. The central bank expects a recent spike in inflation to be short-lived, but in a surprise move, two officials pushed for an even bigger rate cut. Take a look.
The Bank of England cut interest rates on Thursday. The quarter percentage point reduction to 4.5% was in line with expectations. But investors were surprised by two officials who unexpectedly voted for an outsized rate cut. One analyst said their decision may reflect worries some policymakers have about the headwinds to growth. Governor Andrew Bailey said the central bank would monitor the UK economy and global developments closely.
This will be welcome news to many, and we expect to be able to cut bank rate further as the disinflation process continues. But we will have to judge, meeting by meeting, how far and how fast.
He added they would take a gradual and careful approach to reducing rates further. The British economy has barely grown since midway through last year. It's been hit by rising costs, worries about Finance Minister Rachel Reeves' tax increases for employers, and the risk of a global trade war led by US President Donald Trump. The Bank of England warned the economy likely contracted by 0.1% in the fourth quarter. Thursday's rate cut is only the third since the bank started lowering borrowing costs from a 14-year high in August. It leaves British rates among the highest for advanced economies. In a sign of concern about the future, the central bank halved its growth outlook for this year to 0.75%. It reflected weak business and consumer sentiment and slower productivity growth.
All right, on to Japan now. After much speculation, Nissan CEO Makoto Uchida met with Honda CEO Toshihiro Mibe on Thursday to end their merger talks. According to sources, Nissan walked away after Honda proposed making Nissan its own subsidiary. We'll leave you with that package.
Nissan has told Honda it wants to call off merger talks. That's according to a Reuters source on Thursday. They say the Nissan boss met his Honda counterpart earlier to break the news. The Japanese automakers had said they planned to discuss integration under a holding company. That would have created the world's third largest car firm. But the talks have reportedly soured amid growing differences. Multiple sources say negotiations hit a wall after Honda said it wanted to turn its smaller rival into a subsidiary. Nissan has reportedly rejected the idea. There was no comment on the latest reports from either firm. Both would only say they plan to decide their next steps by the middle of the month. Analysts say Nissan looks more vulnerable if the merger does fall through. It's been buffeted by one crisis after another and is in the middle of a turnaround plan. Over recent years, its market value has declined to around a fifth of Honda's. Such worries initially saw Nissan shares plunge when it was first reported the merger might fail. However, shares in the firm rose strongly in Thursday trade, up over 7% in the afternoon. Bloomberg has reported that Nissan will seek a new partner if the Honda plan does collapse.
And I'm falling.